What if I told you that the difference between living paycheck to paycheck at 65 and retiring comfortably at 50 isn't about earning millions? It's not about getting lucky with crypto or starting the next Amazon. The real difference comes down to understanding one simple principle that most people discover too late, if they ever discover it at all. Right now, there are two versions of your future self. In one version, you're 60 years old, still working, still stressed about money, still counting down the years until you can finally rest. In the other version, you're 45, waking up without an alarm, spending your days however you choose, with money flowing in whether you work or not. The gap between these two futures isn't as wide as you think. It's not about making different career choices or getting a better degree. It's about understanding the invisible force that either works for you or against you every single day. And here's what nobody tells you. For most of your life, this force has been working against you. Think about the last time you bought something on credit. A car maybe, or a house. You borrowed money, and now you pay interest every month. That interest is the price of using someone else's capital. Every payment you make is wealth flowing away from you and towards someone else. You're on the wrong side of the equation, but here's the game changer. You can switch sides. Instead of being the person who pays interest, you can become the person who collects it. Instead of renting your future income to cover past purchases, you can own assets that pay you indefinitely without requiring your time or energy. This is the central truth of wealth building. And once you understand it, everything changes. The question isn't whether this works. The question is whether you're willing to play a different game than everyone around you for long enough to see the results. The mathematics of freedom. Let's talk about the math that determines your financial future. Not the complicated formulas that require a finance degree. The simple, unavoidable math that governs every dollar you'll ever earn. Here's the brutal reality. If you save $500 a month for 40 years with no investment returns, just putting it under your mattress, you'd have $240,000. That sounds like a lot until you realize that inflation has been eating away at it the entire time. What costs $100 today will cost $180 in 20 years at just 3% inflation. Your $240,000 in 40 years will have the purchasing power of maybe $75,000 today. This is why saving alone is a losing strategy. You're running on a treadmill that's slowly speeding up, and no matter how fast you run, you're falling behind. But here's where it gets interesting. Let's say you take that same $500 a month and invest it at an average return of 8% per year. After 40 years, you don't have $240,000. You have $1.7 million. Same effort, same discipline, but exponentially different results. The difference is compounding. And compounding is the most powerful wealth-building force in existence. Albert Einstein allegedly called it the eighth wonder of the world. Those who understand it earn it. Those who don't pay it. But here's what most people miss. Compounding isn't just about investment returns. It applies to every area of wealth building. Your skills compound. Your network compounds. Your knowledge compounds. Every improvement you make builds on the previous one, creating geometric growth instead of linear growth. Let's break down what this means in practical terms. If you invest $10,000 and it grows at 8% annually, in year 1, you earn $800. Not life-changing. In year 10, that same $10,000 is now worth $21,589, and that year's growth is $1,727. By year 20, it's worth $46,610, and that single year's growth is $3,729. You're earning more in 1 year than you put in originally, and you haven't added a single extra dollar. This is the power curve. And the critical insight is this. The curve starts flat and stays flat for years. This is where most people give up. They don't see the dramatic results they expected, so they assume it's not working. But if you can push through those flat years, you reach the inflection point where the curve suddenly shoots upward. The tragedy is that most people quit right before they reach this inflection point. They put in years of discipline and effort, then walk away just months or years before their wealth would have started accelerating on its own. The 3 income streams. If you look at anyone who's achieved financial independence before 60, you'll notice something. They don't rely on one income source. They've built what I call the 3-stream system. Each stream serves a different purpose, and together they create a foundation that's almost impossible to break. Stream 1 is active income. This is your job, your business, your direct exchange of time and skill for money. This is where most people stop. They optimize this one stream, trying to climb the corporate ladder or grow their business, but they never build the other two streams. That's why they're stuck trading time for money until they physically can't anymore. Active income has a ceiling. There are only so many hours in a day, and there's only so much any company or client will pay for your time. Even if you're making $200,000 a year, if you stop working, that income stops immediately. You're one layoff, one health crisis, one burnout away from zero. Stream 2 is growth assets. This is where you take a portion of your active income and convert it into appreciating assets. Stocks, real estate, businesses you own but don't operate. These assets don't pay you much now, but they grow in value over time. This is your long-term wealth engine. The key with growth assets is patience. You're not trying to get rich quick. You're trying to capture the average returns that markets have provided for decades. An index fund tracking the S&P 500 has returned about 10% annually over the long term. Real estate in growing markets has appreciated 3 to 5% annually, plus rental income. These aren't sexy returns, but they're reliable and they compound. Stream 3 is passive income. This is cash flow that comes in whether you work or not. Dividend stocks, rental income, royalties, business profits you collect as a silent partner. This stream is what ultimately allows you to retire early because it replaces your active income. Here's the strategy that works. Use your active income to build growth assets. As those assets accumulate, gradually shift a portion into passive income generators. In the beginning, maybe 80% of your investments go into growth and 20% into income. As you get closer to your retirement target, you flip that ratio. The mistake most people make is focusing too heavily on passive income too early. They buy dividend stocks that yield 4% when they could be in growth stocks returning 12%. They buy rental properties that barely break even after expenses when they could be investing in index funds with zero maintenance. In your wealth building phase, prioritize growth. You want your money multiplying as fast as possible. Only when you're approaching your target number should you start shifting toward income production. The lifestyle arbitrage. Here's a truth that makes people uncomfortable. Your lifestyle is the single biggest factor determining whether you'll ever achieve financial independence. Not your income, not your investment strategy, your spending. I know someone who makes $60,000 a year and has built a $400,000 investment portfolio by age 35. I know someone else who makes $180,000 a year and has less than $50,000 saved at age 42. The difference isn't intelligence or opportunity, it's lifestyle. The person making $60,000 lives on $40,000 and invests the rest. The person making $180,000 lives on $175,000 and invests the rest. One is on track to retire at 50. The other will be working into their 70s. This is what I call the lifestyle trap. The more you earn, the more you spend. You upgrade your apartment, your car, your vacations, your dining habits. You tell yourself you've earned it. You deserve it. And you're not wrong, but every upgrade extends your working years. Here's the mathematical reality. Every $1,000 you spend per month is $12,000 per year. To replace that with passive income at a 4% withdrawal rate, you need $300,000 invested. If your lifestyle costs $6,000 per month, you need $1.8 million to retire. If it costs $3,000 per month, you need $900,000. The lower your expenses, the sooner you're free. This is why geographic arbitrage is so powerful. If you can earn a developed world income while living in a place with lower costs, you create a massive arbitrage opportunity. Remote work has made this possible for millions of people. You can earn $80,000 working for a US or European company while living in a place where $30,000 gives you an excellent lifestyle. But even without moving, you can create lifestyle arbitrage. The key is separating the things that genuinely improve your life from the things you buy out of habit, social pressure, or the need to signal status. Ask yourself, what purchases actually make you happier 6 months later? For most people, it's a surprisingly short list. Experiences with loved ones, health and fitness, learning and growth, time freedom. Most of the stuff we buy falls off the happiness radar within weeks. The goal isn't to live like a monk, it's to consciously design a lifestyle that maximizes happiness per dollar spent. Maybe you love dining out, so you allocate money for that, but you don't care about cars, so you drive something reliable and paid off. Maybe travel fills your soul, but you're fine with a small apartment. This is personal. There's no universal right answer. But here's the key. Every dollar you're not spending is a dollar that can work for you forever. That's the trade-off. A $50,000 car today costs you about $4,000 per year in passive income for the rest of your life. Is it worth it? Maybe. But make that decision consciously, not automatically. The income acceleration strategy. While controlling expenses is critical, there's a hard limit to how much you can cut. You can't reduce your spending below zero. But your income? There's no ceiling. And this is where most people leave massive amounts of money on the table. The average person treats their income as fixed. They accept their salary, maybe negotiate a small raise every few years, and assume that's the game. But the people who build wealth fast understand that income is the most controllable variable in the wealth equation. Here's the strategy. Think of your career as a series of compounding skills. Every skill you develop makes the next skill easier to learn and more valuable. If you're a marketer who learns data analysis, you're suddenly worth more than a marketer without that skill. If you then learn basic coding, you're in an entirely different category. The same applies to roles and responsibilities. Every time you take on a project outside your comfort zone, you're adding to your skill stack, and the market pays exponentially for rare combinations of skills, not linearly for individual skills. But here's where it gets really interesting. At some point, you should stop thinking about your income as something someone else pays you and start thinking about it as something you create. This doesn't mean you have to quit your job and start a business tomorrow. It means you should be building assets on the side that can eventually produce income independent of your time. This could be a consulting practice where you solve specific problems for clients. It could be a digital product that sells while you sleep. It could be a YouTube channel, a newsletter, an app, a course. The form doesn't matter. What matters is that you're building something that can scale beyond your hours. Most people never start because they're waiting for the perfect idea or the perfect moment. But the truth is, you learn by doing. Your first attempt will probably fail or generate minimal income. That's fine. You're not trying to replace your salary in year one. You're trying to learn the skill of creating value outside of a traditional employment structure. And here's the compounding effect. Let's say you make $70,000 at your job. You start a side project that generates $500 per month in year one. That's only $6,000 per year, barely noticeable. But if you reinvest that income back into the project and grow it 30% per year, by year 5, it's generating $27,000 per year. By year 7, it's matching your salary. Now you have options. You can keep your job and invest 100% of your side income, accelerating your path to financial independence. Or you can quit and scale the side project into a full-time business. Or you can negotiate part-time status at your job and split your energy. The point is, you've created leverage. This is how people retire in their 40s without winning the lottery. They didn't just save aggressively, they increased their income dramatically over a 10 to 15-year period, then invested the surplus. The risk management paradox. Here's something nobody tells you about building wealth. The biggest risk isn't taking chances. It's playing it too safe. Most people are terrified of losing money, so they keep it in savings accounts earning 1% while inflation runs at 3%. They're guaranteeing that they lose purchasing power every single year. They think they're being conservative, but they're actually being reckless with their future. The real question isn't, what if I lose money? It's, what if I don't build wealth? Because the cost of not building wealth is working until you physically can't, having no cushion for emergencies, and being completely dependent on a system that doesn't care about you. Here's the paradox. Taking calculated risks early, when you have time to recover, is actually the safest long-term strategy. If you're 30 and you invest aggressively, even if the market crashes and you lose 40%, you have decades for it to recover and grow. History shows that the market always recovers given enough time. But if you play it safe until you're 55, then try to catch up by taking big risks. You have no margin for error. A crash near retirement can destroy your plans because you don't have time to wait for recovery. This is why the conventional wisdom is backward. When you're young, you should be taking more risk, not less. Not stupid risk like gambling or speculation. Calculated risk like investing heavily in growth stocks, starting a business, changing careers for higher income potential, moving for better opportunities. The safest path is the one that gives you the most options later. And options come from building wealth early, even if that means enduring some volatility and uncertainty along the way. But here's the critical distinction. Risk management isn't about avoiding risk. It's about understanding which risks are worth taking and which ones are simply gambling. Good risks have asymmetric upside. If you fail, you lose a limited amount. If you succeed, the gains are enormous. Starting a side business with $5,000 is a good risk. The downside is losing $5,000 in some time. The upside is potentially unlimited income. Bad risks have capped upside and unlimited downside. Buying a liability like an expensive car on credit is a bad risk. The upside is limited to the enjoyment you get from the car. The downside is years of payments that limit your financial flexibility. The people who build wealth understand this difference. They take calculated risks that increase their potential for gain while managing their exposure to catastrophic loss. They don't gamble. They don't speculate. They don't follow trends. They make boring, disciplined decisions that compound over time. The final phase. There comes a moment in your wealth-building journey when something shifts. You check your investment accounts and you realize that your money grew more last quarter than you earned from working. This is the crossover point, and it changes everything. Up until this moment, you've been the engine. Your labor, your savings, your discipline, these were the primary drivers of your net worth. But after the crossover point, your capital becomes the engine. You become the navigator, making adjustments and staying the course. But the heavy lifting is done by your accumulated wealth. This is when early retirement stops being a distant dream and becomes a practical reality. Because now you can do the math and see the finish line. If your portfolio generated $40,000 last year and you're living on $60,000, you know you're close. 1 or 2 more years of contributions and growth, and you're there. But this is also the most dangerous phase, because the moment you can afford to retire, you're tempted to spend more. You see the wealth accumulating and think, I can finally relax. And if you're not careful, lifestyle inflation kicks in right when you're on the verge of freedom. The people who succeed in this final phase understand that crossing the finish line isn't about hitting a number. It's about building a system that sustains itself indefinitely. That means having enough capital that you can withdraw 3 to 4% per year and still have your portfolio grow enough to outpace inflation. If you need $50,000 per year to live, and you want to use a 4% withdrawal rate, you need $1.25 million invested. That sounds like a massive number, but if you've been investing aggressively for 15 years, it's achievable even on a moderate income. And here's what happens after you cross that line. You don't stop. You keep investing, keep growing your capital, because now you have true security. You're not just surviving on your investments, you're thriving. You have margin for unexpected expenses, for helping family, for pursuing passion projects that might not be profitable. This is the difference between financial independence and financial abundance. Independence means you don't have to work. Abundance means you have so much margin that money rarely factors into your decisions. Most people never get here because they don't start early enough, they don't invest aggressively enough, or they give up during the flat years before compounding takes over. But if you can avoid those mistakes, if you can stay disciplined through the boring middle years, this is where you end up. The path to early retirement isn't complicated. It's just uncommonly disciplined. Save aggressively, invest consistently, control your lifestyle, increase your income, give compounding time to work. The math is simple. The execution is hard because it requires you to live differently than everyone around you. While they're upgrading their lifestyle with every raise, you're investing the difference. While they're chasing the next trend, you're staying the course with boring index funds. While they're spending their weekends consuming, you're building skills and income streams. But here's the reward. In 15 or 20 years, while they're still working, still stressed, still trapped in the cycle, you'll be free. Not because you got lucky, not because you earned millions, because you understood the system and played the long game. Every dollar you invest today is working for your future self. Every sacrifice you make now buys you freedom later. And the best part? Once you reach the crossover point, once your money is working harder than you do, you never have to go back. The question is simple. Are you willing to live like no one else today so you can live like no one else tomorrow? Because that's the trade, and it's the best trade you'll ever make. If this video gave you clarity on your path to financial freedom, like and subscribe. And if you're ready to go deeper, check out the next video on your screen. Your future self will thank you.